Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard to borrow stocks and potential short squeezes. Ever wondered what happens when short sellers find themselves in a tight spot, facing astronomical fees and dwindling shares? Today, we're peeling back the layers on a specific company that's appeared on our hard to borrow screener, and that's the Grow Up Limited, trading under the ticker TGHL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight to it. The Grow Up Limited, or TGHL, operates in the technology and software infrastructure sector. They are an investment holding company providing product traceability, data analytics, and product trading facilitation solutions primarily in Singapore and internationally. This isn't just some micro-cap penny stock, they offer real-world, relevant solutions. As of today, TGHL holds a market capitalization of $20.04 million. Looking at the recent price action for TGHL, it's been a bit of a roller coaster. Today, the stock is up a significant 17.64%. However, over the last 5 days, it's actually down 22.40%. Zooming out a bit, the last 30 days have seen TGHL climb 28.71%. Third chart TGHL daily chart highlighting these periods. Volume has been notable too. Today's volume hit 5,880,500 shares. Compared to its 30-day average volume of 10,264,456 shares, today's relative volume is about 0.6 average, so while solid, it's below its recent average. What is cost to borrow and why it matters? So, what exactly makes a stock hard to borrow, and why should you care? At the heart of it is the cost to borrow, or CTB fee. This is the annualized interest rate that short sellers pay to borrow shares before they sell them. Think of it like a loan interest rate, but for stocks. When a stock CTB starts to skyrocket, it's a big red flag for short sellers and a potential indicator of impending pressure. Why can these fees exceed 100% annually? Simple economics, supply and demand. If a stock becomes highly sought after by short sellers, but the supply of shares available to lend is extremely low, the cost to borrow those few available shares can become astronomical. It's the market signaling intense scarcity. Why this stock is hard to borrow right now. And that brings us to why TGHL is on our radar. The Grow Up Limited currently boasts an annualized cost to borrow fee of a staggering 773.1%. Highlights CTB, that's right, over 700% just to hold a short position for a year. While we don't have the exact number of shares currently available to borrow, a CTB fee this high almost invariably points to an extremely limited supply. TGHL has an estimated float of 12.7 million shares. A smaller float means fewer shares are generally available for trading and borrowing, amplifying the impact of scarcity. On our internal 0-100 scale, which combines CTB level, CTB momentum, shrinking borrow supply, float size, and price/volume action, TGHL scores a composite squeeze score of 46.5. This score suggests that while there are definite squeeze characteristics present, it's not yet in the extreme high pressure zone. Squeeze mechanics explained. For those new to this, let's quickly explain how a short squeeze works. A short seller borrows shares and sells them, hoping the price will drop so they can buy them back cheaper, return them, and pocket the difference. But if the price starts to rise instead, their losses grow. When a stock becomes hard to borrow, like TGHL, and the CTB fees skyrocket, it compounds the pressure on these short sellers. Brokers can also issue what's called a share recall, demanding that borrowed shares be returned. When this happens, short sellers are forced to buy shares back in the open market, regardless of the price, just to close their positions. This forced buying, especially when there's a limited supply of shares, creates a rapid surge in demand, which can dramatically push the stock price higher. That's the essence of a short squeeze. Now, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One critical factor that can absolutely kill a short squeeze thesis, even with high cost to borrow fees, is dilution. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This essentially spreads the company's value across more shares, which can depress the stock price. More importantly for short squeezes, a sudden influx of new shares can provide a much-needed supply for short sellers to cover their positions, effectively diffusing the squeeze potential. So, what's the situation with the GrowHub Limited? We've checked for recent dilutive SEC filings -1s, -3s, 424 BS over the last 90 days, and found no recent dilutive filings for TGHL. Furthermore, we found no recent reverse splits in our look-back window. This is a positive sign, as it means there isn't an obvious near-term source of new shares to dilute the float or help shorts cover easily. Just a quick reminder before we continue. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, for the GrowHub Limited TGHL, what should you be watching if you're interested in this dynamic? Keep an eye on the cost to borrow fees. Any sustained increase or continued high level is significant. Monitor the reported shares available to borrow. If those numbers drop further, it's another squeeze indicator. Pay attention to TGHL's daily trading volume. While today's was below average, a sustained surge in volume, particularly on upward price movement, could signal increasing buying pressure. Also, watch for any fundamental news or catalysts from the GrowHub Limited itself. Sometimes a positive company announcement can be the spark that ignites a short squeeze. The GrowHub Limited TGHL presents an intriguing case study with its astronomical 773.1% cost to borrow fee and relatively small estimated float. While not every hard-to-borrow stock squeezes, TGHL certainly has some of the key ingredients that can create significant pressure for short sellers. Remember, this is about understanding market mechanics, not making a prediction. Always do your own thorough due diligence. If you found this deep dive into TGHL helpful, please give us a like, subscribe for more unique stock insights, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.